Lorene, I'm also curious what you would advise people who want to minimize their exposure to big tech or who are on the more conservative end of the spectrum. I mean, you can't avoid it if you're in any tech index funds, if you're basically in the S&P 500. I mean, it's just such a big portion. So it's not just about, whether you do or don't pick those names, right? There also has to be a strategy for how do you avoid overexposure, if that's what you think it is, through everything else you own.
Well, just to your point, right, you're saying of the S&P 500, those top 5 names represent about 25% of the S&P 500 index. And so that's why we're saying it's a stock picker's market. Look at individual holdings versus going S&P 500. Now we're looking at potentially Tesla being part of the S&P 500 as well. So you're going to have a crowded space with a lot of technology in the S&P 500. And we're looking at other ways to diversify. So like you said, for people who are looking at other areas, if we just look at the disparity between large cap growth, which is up around 13%, and large cap value down around 13%, at some point we're going to see a rotation towards the value side of investing. And just like we did with the dot-com bubble, and for a long time, value investors looked like they didn't know what they were doing, we will eventually see the same rotation into value. So what I'm saying to investors is look at some of those value names. Look at some of the small and mid cap names. Where we've seen the run up has really been on large cap growth.
So, Kevin, what happens when eventually this run with the big cap tech names stops, both obviously for people who are in them, but for the whole market?
Yeah, you could get a rotation into value, but if you look at how the value indexes are constructed, the construction methodology largely ignores debt. We're 20 years into a very long, easy credit cycle, and even though the valuations look good based on book value, let's say, it's really important to recognize that cycle and that at some point there's going to be a real demand for quality and flexibility. So in an environment like this, where you've got a lot of debt on corporate balance sheets, where you have the S&P earnings down 40% in the second quarter, tech's down 10, down 10 in a down 40 environment is almost like being up as far as we're concerned. It's very important to focus on flexibility, and it is probably worth paying a premium for that. So the way that we say it, if you have a longer-term time frame, you want to go with flexibility. You want to go with quality. That's going to include technology. It's going to include in healthcare a bunch of consumer names. But don't be just guided into value just because something looks cheap relative to book value, because you're probably buying risk that is being properly priced into the market. You got to be careful of that if you're a stock picker.